Good evening, everyone. Please, can you hear me?
Yes.
Okay, good evening, everyone. So, we are going to keep the ball rolling now. So, welcome to another edition of Question and Answer with Cole and Associates. So, Cole will be joining us soon. He's currently in transit. So, but we are going to continue till he joins. So, this month, we are going to be looking at ISA 560 for audit, tax implication of foreign exchange and loss for tax, and also IAS 10 for financial reporting. So we have our guest speakers in the house. We have Said Ridwan for ISA 560 from audit. We have Afola Shade for tax, which is tax implication of foreign exchange and loss, foreign exchange gain and loss. And we also have Amazing Peace for IAS 10. So please, can you give us a small introduction, starting from grade 1?
Okay, good evening, everyone. Okay, ISA 560, and that simply means, or it talks about the subsequent event. ISA 560 is one of the standards in the International Standard on Auditing, ISA, which provides auditors with a framework for dealing with subsequent events in an audit of financial statements. It explains guidance on how the auditor's responsibility is going to be like regarding subsequent events.
Okay, thank you very much. So if we talk about subsequent events, can you shed light on what is subsequent event, please?
Okay, thank you so much. When we say subsequent event, literally the word subsequent means coming later or after something else has happened at a particular period of time. But according to the standard, the subsequent events are those events that occur between the date of financial statements and the date of auditor's reports, as well as facts discovered before or after the financial statements and auditor's reports is being issued to the public for usage or for decision making and all other purposes.
Okay, thank you very much. So we are still going to come back to ISA 560 in full. So now let's go to tax implication of foreign exchange gain and loss. Afola Shade, are you there?
Yeah, good evening.
Yeah, good evening.
Good evening, everyone. So, for this month, we'll be talking about foreign exchange gain and loss, the implication of the foreign exchange gain and loss, and how to treat it for tax purposes, whether it is realized or not realized. We'll be talking more explicitly on that during the course of today's discussion.
Yeah, thank you very much. So moving to financial reporting, IAS 10. So Amazing Peace, please can you give us a brief introduction on what IAS 10 is all about?
Okay, good evening, everyone. IAS 10, that's events after reporting date. And this standard applies to events that occur between the end of the reporting period and when the financial statements are authorized for issues. It is categorized into the adjusting and the non-adjusting events. And we'll look at the reporting date, the authorization date, determining the adjusting events and events that are not to be adjusted. So that's summary of IAS 10, events after reporting date.
Okay, thank you very much. So please can you give us a brief example of things that are to be adjusted and things that are not to be adjusted?
Okay, thank you. For adjusting events, I will start with the definition. Adjusting events are events that provide evidence, they provide additional evidence about conditions that existed at the end of the reporting period. All this evidence provided, they require amendments in order to ensure the accuracy of the financial statements. While non-adjusting events, they are events that occur at the end of the financial reporting of an entity, but they do not require amendment. They only require disclosures. The disclosures will be made in the relevant notes to the accounts. So some examples of adjusting events are, you can say, obsolete inventory. For example, now when an entity has obsolete inventories, we see that this is going to reflect a loss in the financial statement, and you have to show that loss in your financial performance, the statement of financial performance, and then the impaired inventory in the statement of financial and financial position, in order to reflect the true account of the entity. Another example is the discovery of fraud at the end of the reporting period. Once you discover fraud, it's going to affect the accuracy of the financial statement, thereby there is need for adjustment. Some examples of the non-adjusting events could be when you are announcing a major change, like a major operational change in your business. This does not affect the accuracy of the financial statement, so this is only going to be disclosed in the notes to the account, like that. Then if there is new, like acquisition of a new subsidiary, this also is also going to be disclosed in the notes to accounts. So that's just examples of adjusting and non-adjusting events. Thank you.
Yeah, thank you very much. Amazing piece. So to everybody joining us, I say welcome once again. So this is another episode of Question and Answer with Cole and Associates. And just like I said when we started, Cole is in transit, but he's going to join us anytime soon. So I'm just trying to hold forth before he joins us. So going back to ISA 560. Uridwan, are you there?
Yes, I'm here.
Okay. Thank you very much. So when we talk about ISA 560, does this subsequent event, does it have impact on the financial statement element? And if it does, can you explain to us briefly?
Okay, yeah, thank you so much for that. Remember, as we've mentioned earlier, according to the standard, the subsequent events are those events that occur between the date of financial statements and the date of auditor's report, as well as facts discovered before or after the financial statement and auditor's report is issued. And for us to understand and answer the question, we also need to understand some certain concepts, which includes the first thing has to do with what is the date of financial statements. Basically, it refers to the end of the reporting period for which the financial statements are prepared. For example, if a company fiscal year ends on December 31st, 2023, then December 31st, 2023 is the date of financial statement. Then alongside with that, we also have date of approval of financial statements. The date on which the statements that comprise the financial statement, including the related notes, have been prepared, and those with the recognized authority have asserted and taken responsibility for those financial statements. Also to understand is the date of the auditor's report, and basically this is the date the auditor signs the financial statement. And the last one is the date of the financial statement issue. This is the date when the auditor's report and the audited financial statements are available to the third party. As such, with respect to whatever event that happened, which is the subsequent event, it has an implication in financial statements, and it also does not have, based on whatever the situation is. And for the one that is having the effect, it's going to be a thing of what you will disclose in the note to the accounts, or you also make necessary amendments as expected.
Hello, sir.
Hello.
Hello, sir. Are you hearing me, sir?
Yes, we can hear you.
Okay, sir. When we are publishing statements, sometimes we notice that we have a kind of a lump sum amount of money at the previous years. And for example, maybe we are using a software accounting. How are we going to reconcile it with the present accounting periods?
Which one? Did you hear that question?
Yeah, Ben.
Okay.
Good afternoon. Good evening, everyone.
Hello, sir.
Yeah, good evening, everyone. Confirm if you can hear me, please.
I can hear you.
Sir. Yes, we can hear you.
Okay. Apology that I joined late. I was held up in the traffic. Just for proper clarity, I need Ben to put his question across again. Can you explain yourself again so that we can address the question properly?
Okay. The question is, if for I'm using accounting software to record all my transactions, and we have a bad luck of we have some records, accounting records, which are about 10 months ago, 8 months ago, and we just acquired the software, and we need to move it to our current accounting period for this year. So how are we going to reconcile that?
Okay, two approaches are visible.
Okay.
Number one is that you have option one of updating the software with all the information starting from the very first time that you start to operate the business. So that means if the 10 months ago, if the 10 months ago begins on the 1st of January 2020, say for example, so you start your posting from that 1st of January 2020. That is option one.
Okay.
And that's a function of, do you have all the necessary clarity and explanation that you need to ensure that you post the information as clear as possible. But option two is most visible when the period you have before you acquire the software is so much that it may be impracticable for you to go back retrospectively. So what you could then do is to have that very account audited to the date when you want to kickstart the software, right? So it is the audited balance, that is the balance sheet items, the balances that have been audited, that you will then transfer into the software as the opening balances. Do you understand? So, like I said before, is it visible posting all the day-to-day transaction before you acquire the software? If it is visible, please start it from the very beginning, because it makes more sense. You have all the details, the ledgers and every other thing there. But if it is not practicable for you to doing that, you can have the account audited till that date while you now migrate the opening balances into the software. Does that answer your question, please? Ben, does that help? Ben is not listening.
Hello.
Does that help?
I'm with you, sir.
Yeah, I said, does that help? Do you understand that?
Yes.
All right.
Okay. Yes.
All right. So, once again, I'm very sorry that I had to join this late. For everyone who is around today, I want to formally welcome you, and I wish you a very fruitful conversation today. Just as my colleague has started, Ridwan, he's been speaking on
I believe ISA 560. Read one, I hope I'm right.
Perfectly right, sir.
All right. The standard ISA 560, which refers to subsequent events, is a very trivial standard. For every auditors in the house or those who may aspire to working in an audit capacity or in an audit firm, it's a very important standard you should know. By the way, for those who have not been part of this from the very beginning, this is anchored by KCP. KCP is a firm of chartered accountants. We offer accounting services, audit services, regulatory services, HR services, and tax services, right? This engagement we are having is part of the way we can give back to the public and also help each other in the course of our professional practice, right? When we say ISA is International Standard on Auditing, right? And it is a standard that gives guidance to auditors on how or what they should do in each of the process of their auditing engagement. So there are quite a number of those standards, and one of those unique standard is what we call ISA 560, right? I believe that there have been some conversation before I join, but I want us to realign it in such a way that even anyone who doesn't have audit background will be able to understand. When you say subsequent event, my colleague Ridwan, would you like, in a layman's way, can you explain what subsequent event means before we go into the nitty-gritty of the standard?
Okay, thank you so much for that. When we say subsequent event, literally it means coming later. Or when we say subsequent, literally it means coming later or after something else at a time. Then with respect to the standard we are treating, which is the ISA 560, then subsequent events are those events that occurred between the date of financial statements and the date of auditor's reports, as well as facts discovered before or after the financial statement and auditor's reports is issued.
Very well. So for the benefit of those who are not core accountants, event in accounting means transactions. Transactions means the act of buying and selling. For accounting purpose, what you bought and what you sold, right, must be reported, right? In the course of you reporting there is need for you to have a cutoff, for you to have a time frame. In accounting, we call that periodicity concept. So it is that concept that emphasizes that financial statements must be prepared for a definite period, right? So with that very understanding, when we now say subsequent events in the wordings of Ridwan, it means you have prepared an account, say from January to December of a particular year, right? What happens after that very year till when the audit must be done? Remember, if you look at the period January to December of 2023, for example, there is no how the 2023 account will be audited within 2023. Even if there is during the year audit, it cannot be completed. So there is a need for us to understand that audit of a particular year will only occur after that year, right? So in her illustration, if December is a cutoff period, the period to which you prepare the account to, and the account is not audited until, say, May. The audit that begins in May was not finalized until, say, July. What happens between period after that December, which is the cutoff period of your financial statement, till when the audit is finalized, is what we call the subsequent event. So what this standard is talking about is how will events that occur after the year end. Don't forget, the financial statement is reporting on the financial period. What happens after that very period? How could that affect the positions, the disclosures, the cash flows, and every other presentations in the financial statement? Coming back to you, Ridwan, what are some peculiar things that you think, from experience, you've identified could occur during that subsequent event?
Okay, thank you so much for that. From experience, some peculiar things that could occur or that can occur has to do with the following. The first one has to do with the ripple effect on inventory. And basically, when we say the effect on inventory, probably at the date of the reporting date, which is the 31st December 2023, based on the instance you cited, there was a particular issue with respect to the value of inventory that has been reported. Let's say technology could break through, renders the product obsolete. In that case, what happened after that reporting date is said to be a particular issue. And in that regard, if the product market value has significantly decreased, the company may need to adjust the inventory figure to reflect the lower value, or the value as it were, as at after the reporting date.
All right, thank you very much. Let me put it more clearer to our audience. For one to be a solid or a good auditor, you need to have a good understanding of what we call the accounting standards too. So in the course of some of this presentation, even though the discussion is on audit standard, we may be having interference with one or two accounting standards. So he has rightly cited that among the numerous things that could happen, there is a peculiar one which we call inventory. Inventory is popularly known as what we call stocks, and stock is what a company sells. So if you are selling, say for example, you are selling furniture, right? And at the year end, December 2023, in our example, you have inventory unsold that has not been sold, what say 10 million naira, right? What Ridwan is trying to say is that during the period the audit is taking place, that is after December till July, when it was finalized, any item of the account that qualifies as an event or a subsequent event to be disclosed or to be adjusted, right? The moment you identify it, you need to look at it to be sure that nothing has occurred that could have make it lose value that was reported as at December 2023. So in our instance, inventory worth 10 million naira, right? Ridwan, I'm still coming back to you. What are some peculiar things that could happen to that inventory that would make its value to either be adjusted or be non-adjusted?
Okay, for the inventory to be adjusted, if I get you right, it has to do with first thing we have to also look at is the nature of the inventory. And let me just cite an instance. If it's said to be an electronic situation where we have electronic
Why not
inventory,
use the furniture I cited?
Okay, let's say the furniture you cited, and in that case we have obsolete with respect to some of the items which has reduced the value reported as at the 31st December 2023. In that case, what is meant to be done is for that inventory to be adjusted.
Okay, yeah, that's a very good one. But in addition, we can also look at it in this perspective. The company is selling furnitures, and during the audits, the management get to know that they get to the office one day and they notice that the whole area has been flooded. Therefore, because of the flood, some of the furnitures were soaked in the water. Obviously, it cannot be sold in that state again. The value that had been reported in the financial statement as at 31st of December 2023 have been distorted. So they cannot continue to carry that value that inventory at the value that it used to be. So this very standard identifies every key component in the financial statement that has been impacted by events after the year end, right? And it outlines how or what the auditor should do such that that very audit will be fair. That very financial statement will be fairly and correctly reported, right? Coincidentally, this particular standard has some intertwine with a peculiar accounting standard. And so joining me in discussing this particular standard, it's my other colleague. What's her name again?
Amazing Peace.
Amazing Peace. I want you to mention that. Amazing Peace, for those who have been following us, Amazing Peace before now is one of our listeners on the other side. And today she's on the hot seat, so speaking on IAS 10. Amazing Peace, would you mind to enlighten the public about what IAS 10 is all about in a very brief manner?
Okay, thank you very much for this. Like I said earlier, I've said a little summary about IAS 10 and I'll go again with it. IAS 10, that's events after reporting date. It's an accounting standard that deals with events that occur between the end of the reporting period and the date when the financial statements are authorized for issue. So now, we've already highlighted the reporting period and when the financial statements are authorized for issue. What is the reporting period? The reporting period is the end of the financial period, the end of the financial reporting period, while the authorization date is when the financial statements are legally approved to be issued by the board of directors or any supervisory board. So IAS 10 that refers to events after reporting date. These events could be classified as adjusting and non-adjusting events. The adjusting events are events that requires amendments. They provide evidence of conditions that existed at the end of the reporting period. This evidence requires adjustment. It requires amendment to the financial statement in order to prove the accuracy of the financial statement.
Please,
whereas the non-adjusted,
sorry, I don't want it to look too complicated because we may have some people on the as the audience who are not core accounting, and as much as possible, I want everybody to have a good understanding of what we are talking about. So good that you've identified that within the purview of IAS 10, the events that occur there, which we have earlier said could be likening to transactions, could be adjusting or non-adjusting, right? And you have also said that in the adjusting, there are certain conditions that could have occurred that could warrant such item to be adjusting. I need clarity with example there. Let us uniquely differentiate without using complicated accounting terminologies. For our audience to understand what could happen for a transaction or an event to be adjusting event, and what could happen for a transaction or an event to be non-adjusting event.
Okay, thank you very much for that. So for the adjusting events, like we're speaking earlier, Ridwan made mention of inventory, obsolete inventory. This would be classified under adjusting events. Suppose we have a company that recorded at the end of the reporting period, they have obsolete inventory. This obsolete inventory is going to reduce the normal inventory available at the reporting period. Thereby, it will require the accountant to make adjustments to the financial statement. Another example we can look at is the discovery of fraud at the end of the financial statement. After preparing your financial statement, if a case comes up whereby fraud was committed, this is going to affect the accuracy of the financial statement, so thereby leading to adjustment of the financial statement. Other examples of yes.
Hold it. I need the auditor to be able to come in there. You are in the course of auditing a financial statement, and let's say Amazing Peace is the accountant or the chief accountant there. You've uniquely identified fraud having occurred and obsolescence of inventory having occurred. Among your, can you explain what you will do in line with ISA 560 on what best audit procedure should be carried out in that two transaction? I need you to be able to identify under which circumstance could either of them be adjusting, and under which circumstance could either of them be non-adjusting. Is Ridwan still there?
Yes, I'm there. Yes.
Okay. Do you understand my question?
So can I just briefly recap so I can get better clarity, please?
Okay, the example she has cited potentially could fit in as adjusting and non-adjusting, right? So you are the auditor on the audit engagement, wherein Amazing Peace is the CFO. They have presented the financial statement. In the course of your audit process, you discovered subsequent events, which she, in her own accounting terminology, has called events after the reporting date, right? And two unique examples here: inventory and fraud. Under what circumstance could events that occurred on the inventory qualify as either adjusting or non-adjusting? And under what circumstance could the event that occurred on fraud be adjusting or non-adjusting?
Okay, yeah, thank you so much for that. For events that occurred on the inventory, for it to be non-adjusting, that is when we can be talking about change in market value after the reporting period. And what did I mean by that? If, for instance, after the reporting period, specifically the example we cited, which is the 31st December 2023, it was brought to the notice of the management and even the auditor that this is the new market value. In that case, it's said to be non-adjusting events. That is number one. Then to also go back to the one that will make it to be adjusting, and that is where we mentioned the obsolete, which was mentioned earlier. That is that on the inventory side. Then to move on, basically on the fraud aspect, as the auditor, what is expected of you is to ensure that your audit procedures are very strong enough to capture the nitty-gritty of the fraud activity. And after that has been captured, the next thing to do is to discuss the matter with management, or where appropriate, those charged with the governance. And from the discussion, then it will now be determined what really happened to know if it is going to be what will be adjusting or non-adjusting item with the financial statements. And by discussing with them, they made it realize that with respect to what happened and from your audit procedure, it has a great impact on the financial statement. Definitely, it calls for adjustment. And if otherwise it does not have, it goes for what we can term as disclosure within the notes.
Amazing piece. Are you convinced, based on that, if the auditor comes around and allege that the said fraud would warrant an adjustment on your account, under which circumstance would you not accept that? And if you would accept that, how do you think the presentation will be done? There's an amazing piece there.
Okay.
Do you
Yes,
understand the
I
question?
Can you please come again with it?
Okay, the auditor has followed his audit procedure and has identified two key terms, events that could occur. Let's start with the fraud. And he confirms that, based on the circumstance that occurred, the fraud will warrant an adjustment on the account. Say, for example, the company has XYZ balance in the bank. There have been some unapproved transactions on the bank and reducing the bank balance significantly. And you are convinced that truly that balance as at year end is not what it should be, right? If you are convinced that, first of all, are you convinced that that will be an adjusting event or non-adjusting event? Amazing Piece is not responding. Are you there? Is Alex here?
Okay, I'm sorry, that was a network glitch.
Okay. Do you understand the question now?
You are asking that the fraud is regarded as an adjusting event. So what should you hold on that? Is that what you're asking?
Yeah. How do you make the adjustment? So when you say you want to adjust, what do you then do? That's my next question.
Okay, since the fraud is an adjusting event, it is therefore the work of the accountant to make sure the financial statement is accurate, and it is the work of the auditor to verify that the financial statement the accountant prepared is accurate. So once we notice a fraud as an accountant, we are there to make the necessary adjustments for that fraud, reflect it that there's a fraud.
How do you reflect?
Company.
That's my point. Let's assume the fraud is in the sum of 50 million. The bank balance has reduced by 50 million due to fraudulent activity. What do you then do?
The fraud has to be written off to the P&L account.
Debit what, credit what, so that our audience will understand.
We are debiting the loss to the P&L account.
Okay.
And we are crediting the bank.
Crediting the bank, that's very correct. So for the benefit of everyone here, you've been given an heads up about what adjusting event is within the purview of IAS 10, right? And non-adjusting now, if it is, let's assume that the case is still in court, we've not been able to actually objectively verify that has occurred as alleged. So if it's still an allegation, but it becomes very essential that you have to do something about it, what do you then do in treating that same case as a non-adjusting event? It's an amazing piece there.
Yes, sorry, please come again.
Okay, so I said That example given could qualify as adjusting and non-adjusting. And rightly, it is adjusting because the physical balance has been depleted, right? And you've rightly said that the balance, the accounting entry will then, because your book is still showing that the 50 million is in the account. Meanwhile, it is not physically there, right? So for you to reflect it to what it should be after the fraud, as after the impact of the fraud, in your word, you said you will credit the bank and recognize an expense as a fraud or whatever you want to, nomenclature you want to call it, on your statement of profit or loss, which is absolutely correct. But let's assume that on the other way around, it was an allegation and it is still being deliberated or considered in court or amongst the parties. You've not had that clarity or that conviction objectively that it is what it is. Therefore, it looks like it is more of a non-adjusting event than an adjusting event. Are you convinced, please?
Yes, I am.
Good.
Yes, okay.
So what would you then do when you have events that are non-adjusting?
In a case like that, when we have an event like that, that it's non-adjusting, you have to disclose it in the relevant notes to show that this is just an allegation. You are not sure of these things, so you are going to disclose it in the notes.
All right, so back to me. That is absolutely very correct. So in a nutshell, for the benefit of our audience, when we say a non-adjusting event does not affect the closing balance. The balances will not change. However, we need to enlighten the public that so thing has occurred. So it is just a disclosure requirement in the relevant sections or notes to the account, right, relating to the item that is under further inquiry or investigation, right? Back to the auditor. Under what circumstance or what are the things that you consider about a non-adjusting event? Are there set of issues that you will consider before you approve the disclosure or not? Because disclosure is a very sensitive matter.
Okay, yes. If I get you right, you are referring to things to consider before an event can be pushed towards the non-adjusting in terms of the disclosure. Am I right?
Yeah.
Okay. Basically, the first thing has to do with we considering the implication of that event with respect to the balances that has been pushed forward in the account, and that is the case of the bank balance, most especially when the item has to do with statement of financial position. That is number one. Then the second thing to also consider is said to be what is the level of the materiality being set at the initial time with respect to the audit activity, which is the number two. Then the third one is said to be the implication of that very event on the decision to be made by the users of the account.
Okay, have you considered, it's actually very correct, but have you considered what is the impact on those disclosure on the going concern of a company?
Yes, it's also part of things to consider if it's going to be a threat to the going concern of the company or not, which makes it the fourth point.
All right, so very well said. For the benefit of everyone, I believe it is clear now, especially those who hold various financial reporting positions in their various places of work, or if you are working as an auditor. I believe many a time you come across this, but a lot of people just overlook it. it is very important for you to be very cautious about this. You are auditing any financial statement of a company, and you've been giving relevant information through to the year end, right? You are carrying out the audit after the year end. It is very important that before you say or you conclude that the audit has been concluded, you might need to look at the impact of ISA 560 as rightly considered here. What are events that occur subsequently that you as the auditor need to revisit to ensure that you are not actually making an audit risk. An audit risk is a risk that the opinion you express on that said audit does not hold water. Things are not as it is, rather you are saying all is well, right? So for you to doing that as an auditor, you must also have a good understanding of what is IAS 10 talks about, event after reporting date, and the applicable the applicable accounting standard relating to that element of the account that may be impacted by that subsequent event, right? Say, for example, if that post-audit impact is relating to your PPE, you need to have a good understanding of what your IAS 16 had said. For instance, a company said they have their property, plant, and equipment. One of the components of the property, plant, and equipment is land and building. And this has been reported as 100 billion in the account. During the course of the audit, the management has actually used that building, the documents of that building, to take a loan, and it's not looking like the company will be able to repay the loan. There are cases in the court currently wherein the creditor is pushing for taking over the property. Will that be an adjusting event? Will that be a non-adjusting event? It's a decision for you to make it, right? We have given you the criteria for you to assess that. If the value of that item under consideration would have changed significantly between the year end and the period before when the audit is signed off, then it may be an adjusting event, right? But if there are cases on it, there is a fight or quarrel or legal tussle of ownership because of the underlying facility that have been taken, then it's looking like the company may not be the owner of the PPE as at the time that is done, right? Ridwan, put a little clarity around that again. How will that be addressed if it is the case of being used as a cover for facility taking?
Okay, in that case, it's going to be a situation of we looking at the value critically. Then based on the instance of what you cited, which you mentioned something of 50 million, and with that, it has a great significance with respect to the balances. That is going to be done appropriately. I don't know if I speak to your question rightly. Hello, can you hear me?
Yeah, I can hear you. So I want to believe everyone understand how to treating this when eventually you meet this in the course of your work. I'll come back to you, Ridwan, and the amazing piece. Let's quickly also have a little talk around taxation, which is one of our very important content in the course of the month. In the course of the month, we had considered the tax implication of foreign exchange gain and losses. Oluwagogo, I hope I'm right. Is Bogo there?
You're right, sir.
Okay, and to join me in discussing that, it's Afolashade Elemide. Afolashade, our audience would like to hear from you. What is foreign exchange gain? And under what circumstance could you say it is foreign exchange loss? And there is also this particular issue around when it is realized or it is not realized, right? And what is the tax implication of when it is realized, and what do you do when it is not realized, especially when you are computing your company income tax?
Okay, sir. Good evening, sir. Good evening, everyone. So when we talk about foreign exchange, first of all, what is foreign exchange? Foreign exchange is the trading course between individual, business, and organization in different currencies. Let's say a company in Nigeria is trading as a business with a company in UK. Definitely, there are different currency, as Nigeria is using naira and in UK they spend to pounds. So there's a difference between the currency that is being used. However, the issue of foreign exchange gain or loss can come up when there is fluctuation in the exchange rate. So when we say foreign exchange gain occurs when there is when a country's currency is strengthened against its foreign currency. Let's say let's say a Nigerian company buys a good worth of 1 million naira, $1 million from a US company, and then as at the time when the company bought the goods, the exchange rate was 800 naira to $1. So as at that time, the company has not yet settled the particular vendor. So when the company wants to settle the vendor, let's say the transaction takes place in January. So as at December, when the company wants to settle the vendor, the exchange rate now falls to 600 naira to $1. You know, when the accountant is recording that particular transaction in January, they are recording it as 800 naira. They are making a provision for 800 naira to $1. But as at when they are settling a particular transaction, they are settling lesser than what they have made provision for. And that's a gain to the company. And on the other hand, for the exchange loss, that's when a country's currency devalues compared to another company. Like the example I gave earlier, a company did a transaction with another country, let's say a US company, and then
hold on first. For the benefit of everyone, I believe that you are getting this clearer. As much as possible, we will encourage that you ask questions if at all you have any, especially those in practice that may have something similar to this that has been very worrisome, whether it is on the ISA 560 as we have rightly considered before now, or it is IAS 10. We are not just gathering here to just talking alone, but we want to learn from each other. We want to know how much you have been positively impacted and your competence enhanced by reason of various content that we have shared, of deliberations that we've had on various topical issues. But more importantly, what we are looking at this month, how does it impact your day-to-day work? What challenges do you have in the course of the work? And you are free to asking questions in that regard if you have. Shall we just hold on? Let's see whether there is anybody that has a question. Then we'll quickly come back to you. You can't be reflecting on your thoughts before we get back to you. Any question from anyone? Any question? Or also, Oni Ayomide, I hope I'm right.
Okay, yes, you are right.
Good to have you.
Okay, thank you very much for this. So I have a worrisome question. Like, what happens with the whole dynamics of trying to post on the software? Like, say a software is not robust enough to carry different currency, like different currency fluctuations. So you always have to manually translate it to your Naira figure before you now post it. And we are talking about different transactions within a month. I want to do bank reconciliation and the balance is not balancing because of different exchange rates. How do you arrive at a balanced figure? Like because of the fluctuating exchange rate every day for different transactions that have happened every day. And take for instance payments that were broken down, like instrumental payments. You get what I'm saying? It is normal that we usually lock down prices, like lock down rates for instrumental payments, but even other payments in subsequent times. When bank reconciliation wants to start, it gives quite a hassle to try and lock down a balanced figure of what is in the bank statement and what is in software.
Absolutely, I can relate with you. I can relate to that concern. So what I often advise is that let's start from what the standard requires you to do. The standard requires you to, on every day-to-day transaction, for you to use your spot rate. That is, irrespective of the manipulation the regulators are doing, having discrepancy between the official rates and the black market rates, as the case may be. What is the exchange rate when you actually carry out that very transaction, right? That should be what you should use when you are posting. However, management may have various intents why they might want to align with whether the official rates or any other visible rates, right? But objectivity should be your watchword. And say, for example, let's assume that you made some sales to a particular foreign customer of $100,000 when dollar was 1,000 naira. By the time you are booking that sales and it is on credit, by the time you are booking that sales, you should do your narration in such a manner that will capture the expected amount from that transaction based on that spot rate. So, for example, you will say, sold goods or rendered services worth 100,000 naira, $100,000 at 1,000 naira per dollar. So that helps you to be able to captures what happens if, as at year end, that particular receivable has not been settled, and at that particular date, the receivable then becomes, the exchange rate then becomes 1,850. That is likely to what Folashade is trying to explain in relating to exchange gain, because that is technically a gain. But that gain, has it been realized? It is not yet realized because the money is still in the air. You are still open to having that customer pay you that a higher rate eventually. Do you get my point? So the best way to hedge those concerns is every transactions that you do, especially those transactions that impact your balance sheet. There should be, relating to foreign exchange, there should be a schedule that we call the foreign exchange schedule, right? Which you can then be able to say, this transaction, when it was done, this is the rate. When it was done, this is the rate. The good thing about that is that, one, it helps you to relate with what you have posted. Two, it helps you to be able to ascertain whether you have made a gain or losses on it, those movements in the course of the period. Three, it helps you, especially when FRS will be having their tax audit reconciliation, because most definitely FRS will often may not agree, especially when it is a loss, when you are in a loss position, may not agree with the fact that you are disclosing some losses as realized or unrealized. Do you understand? Because when it is, shall we still explain that much more later on? When you say a loss is realized, you are saying that I've incurred these losses, therefore grants me as a deductible expenses, right? And the onus will then be on you to prove beyond reasonable doubt that truly that losses has been incurred. Oni, I don't understand. I mean, I don't know whether you get my line of conversation. The same way.
Yes, I do actually. I'm following with what you're saying.
Yeah, the same way in some software, you may not have that software having the possibility of being able to manage your fixed asset register for you, right? But you are buying fixed asset on day-to-day basis or as when the need arises. So the onus is on you outside the software to maintain that very register that shows the location, the type of the asset, the details, date of acquisition, the depreciation rate, and all of that manually, and that will aid you to be able to manually calculate your depreciation and bring it into your account. One benefit of that is that in the case of disposal, you can trace exactly which year that asset that we have disposed, which year was it acquired, what was the historical cost, which the fixed asset schedule ordinarily would not have shown in the normal account. So that is the best way for you to address it. I understand the fact that when you have so many transactions done in that very area, it could make that schedule very complex. But my advice is this: FRS will ask for it, auditors will ask for it, because it is not just enough for you to say, I have a foreign exchange gain or I have a foreign exchange losses. Accountants in the house, please take note. You are not doing your company a favor if you have exchange gain that you have not further analyzed into whether it is realized or unrealized. And I will let you know the implication. In my illustration to you on that receivable, you will have made a gain of 850, and say you have reported it in your financial statement that you have made an exchange gain as other income 850 times the number of dollars you are expecting. But in reality, you have not actually earned or realized, you have earned it, but you have not realized this particular gain. If you did not have sufficient schedule to reconcile and be able to convince the parties that it is unrealized, the tax exposure of your company will have increased by the effective tax rate on that gain. Meanwhile, that cash is not there. Situation may still reverse tomorrow, and those reported gain may then be evaporated. So that is one of the reasons why it is very essential when you are reporting exchange gains or exchange losses, go further to analyzing and support it with an appropriate schedule to portray your point whether it's actually realized or unrealized. I hope that is clear. I hope that is clear.
Yes, that is clear. So you're saying that as regards the posting, I should use, say it's FMDQ's NAFEM rate, I should always use their closing rate. That's another dynamic. Should I always use the closing rate for the day, or what? Like, should I always use the closing rate of the day for that particular transaction? Then following day, then the following day, then the following day, any other transaction for any other following day.
You are most likely not balancing your balance sheet on day-to-day.
Exactly.
So,
no, we are not.
Yeah, good. So every time you incur an expense or you incur a capital expenditure or even an income, report it on the spot with the spot rates. The rate based on that particular day, right? Especially if in the case of expense, you actually incur that amount, you will have known how much you actually bought dollar to be able to settle that very expenses, right? So you are using spot rate to report every of those, right? But at the year end, every organization often make a decision around which rate will they most likely use in translating their balance sheet items that are expressed in foreign currency, right? For organizations, for any reason, if you are using the CBN rate, you must be able to convince the users beyond reasonable doubt that if you want to buy dollar or any of the currency today, you will get it at the CBN rate. If that is your peculiarity, of course, you can use the CBN rate as the year-end conversion rate, right? But if you don't have any possibility of being able to source that very dollar at that very rate, I will advise that the black market rate may also not be very reliable, because there is no structure around it when you want to translate your year-end balance. That is why people then often make recourse to other secondary reliable market like the NAFES rate and the likes. Is that clear? So that's what it's often used, and you might also, if you don't have a peculiar policy around that, that may be a next much more reliable rate, because NIFES rate, if you check it, it is most likely an average between the CBN rate and the black market rates. And the fact that it is very verifiable, it can be checked and confirmed by any third party, that's a level of comfort that's okay. When the auditors come, or FRS or any of the regulator is questioning you, you can then say, oh, this is the premise on which we have used this rate, but black market is not visible in that. I mean, it's not that reliable. Is that clear? All right, so good that Ayomide asked that question, and I believe everyone who have listened has gained one or two things from that. Please, it is our honest view that we just don't want people, especially accountants in practice, to chewing gum the accounting standard, but have a contextual working knowledge of it. And that's one of the reasons why we have these deliberations, right? This sort of avenue brings to your mind some of those standards that you probably have forgotten, and this will give you an avenue for you to quickly go and dust it, and in the course of work, when it is applicable, ensure you are using it rightly, right? Then if in the course of your work you also have some challenges or constraints around practical applicability, we have this mentorship group, which is strictly for issues of professional concern of that nature. You can put a call through on that group, post information there without disclosing any entity concern. Advice will be dished out, or you can freely reach out to me or any of the KCP teams. They will definitely address your concern. If there is any need for you to flag it above, that will also be addressed at no cost. So before we continue our conversation on the tax implication of the foreign exchange gain and losses, I still want to give room for one or two more questions. Is there still anyone that have challenges relating to what we are talking about? Even if you are an auditor, how do you think ISA 560 has been very challenging in the course of your work, or how have you been applying it in the course of your work? Anyone? Anyone? Any other question or contributions? It can be question, it can be contribution. Come as we go on. Back to you, Afolashade. You were discussing about foreign exchange gain and losses, tax implication of it in particular. You're trying to explaining under what circumstance could this result to gain, and under what circumstance could it result to loss. When is it realized? When is it not realized? And in particular, what is the tax implication of it? Can you continue in that light?
Okay, sir. Thank you so much for that, sir. So, when you are given as a tax consultant, when you are given a financial statement and we are seeing exchange gain or exchange loss, it is not enough for us to conclude that it is realized or unrealized. We need to confirm, to probe on whether this particular exchange gain or loss, whether it is realized or not. So exchange gain, I'll start with the realized part. Exchange gain that are realized are taxable. For tax purposes, the implication they are taxable. However, when we have exchange gain, they are always stated in the other income, in the statement of profit or loss. We will find it under other income. And when it is exchange loss, when it is realized exchange loss, when it is realized exchange loss, we will find it still under the statement of profit or loss in the financial statement. So when those two are in the financial statement, the part that is realized as exchange gain, it is taxable, and the part that is realized as exchange loss, it is not taxable. However, when we have the part that is unrealized, the unrealized part is saying that the accountant or the auditor, the accountant has already recorded this particular transaction. They've occurred, but it has not been settled or it has not been paid for. It's just for it to reflect the potential impact of exchange, the potential impact of exchange rates on the fluctuation of the future transactions. So this particular transaction, they have not taken place. They've taken place, but monetary value has not been attached to it. And as at that point, for tax purposes, when we see anything that is like unrealized exchange gain or loss, for the unrealized exchange gain, it is in the financial statement, it must have been posted under the statement of profit or loss, so it will be deducted back. It is not taxable. So
okay, sorry again, I had to come back to you on this. You've done several audits, and I believe this kind of issue has become very topical too, especially when you are preparing for an audit and the financial statement of the clients, it's showing that they have exchange gain. You are not too sure, it is not stated there whether it is realized or unrealized. What clarification or documentation would you require from the client to be able to treat that appropriately? What do you often require from the client?
Okay, thank you for that question, sir. For that particular question, what we require from the client is to make clarification if they can provide us with the general ledger for that particular period, and also if they can provide us with the trial balance and the audit adjusted entries. If they can provide us with those information to enable us get clarification on if it is realized or not.
How will any of those information, what do you think, okay, let me put it this way. What are you trying to get in from those information? Because let's assume I'm the client and you said, I've given you the audited account and you requested for trial balance, I've given you. You requested for general ledger, I've given to you. And I ask you, what are you trying to achieve? What are you looking for there? So that we'll be double sure that what you have requested for can actually aid you in getting what you want. So when you review those information, what are you trying to achieve?
Okay, sir. So we are trying to achieve if there is any part of their revenue or expense if there is any part that is done in foreign currency, and if there is any part that is done in foreign currency, that particular part, as the transaction been completed, if it has been completed, the exchange rate that was used, what was the exchange rate that was used, and if it has not been completed, how are they planning to process the payment? Is it that they want to make the payment as at that year? Is it that they are planning to make the payment at a future date, or they are making they've made the payment? So they need to give us the evidence of those information, sir.
All right, thank you. For clarity purpose, the tax consultant in me wants to inquire from the client, because I would not want the client to pay tax on what it has not actually earned in cash, or incomes that may still reverse back to expenses or even losses, right? And within the Nigerian tax framework, even though it is recognized in the regulation, but tax refund is a very, very difficult battle to actually fight the government for. So because of that, my clients who had reported exchange gain, I would want to inquire from the client, what information at all do you have to be sure that convincingly this gain that you have reported, you have collected it in cash. For example, in the illustration that I gave when responding to Ayomid's question, I had sold goods to a client worth $100,000 when dollar was 1,000 naira, right? The receivable becomes unpaid because it was on credit. The receivable becomes unpaid even at year end when dollar was then 1,800 naira. Technically, there are two incomes there. 1,000 times the quantity of the dollars of worth of goods I have sold, which is my actual sales. Then the 850, the notional gain, because of the appreciations of dollar against or at the expense of naira. So I'm recognizing these two incomes, but one is my actual income, primary income, which is the sales, 1,000 naira times the quantity of dollars in question. Second one is the notional gain. Notional gain is not taxable. So I will need to get a convincing fact from the client that this notional gain reported, to what extent has it been turned to cash as the client paid? So if the receivable in question was then settled as at the end of the year, it means that I have actually earned not just the income from the sales, but also the exchange benefit from appreciation of dollar over naira, right? So these are some of the things that we want to be double sure. Every information, transactions or procedures in each client may differ. There is no cast and stone approach to it, right? But most definitely than none, you will want to see that item relating to that foreign exchange transaction, especially the balance sheet items there, whether it is an asset or it is a liability, right? If it is still there on the face of the account as at the year end, it means it is unrealized. Because if it has been realized, most definitely cash should have been earned on it, right? So the client will need to give you evidence. If it's a confirmation that the receivable have not been paid, let's get that evidence alongside with the invoice that has been raised and how this has been reflected in the trial balance and the GL that Folashade earlier mentioned. So please, I'm encouraging you to be very meticulous in your reporting. Report as though the full understanding of that report can be obtained without you being physically there to explain it to anyone. More trivial is the one resulting in expense, because you had reported this amount as an expense. FRS is saying, I'm not going to grant you this very expense as an allowable expense, and you are saying, no, this cost has actually been incurred and it's realized, because when we bought, this time we are looking at purchases. When we bought goods on credit from our creditor, it was $1,000 to 1,000 naira to a dollar. By the time we are paying the creditor, the dollar exchange is now 1,500. So we incur extra 500 above ordinarily what we would have incurred, right? So it is realized in that instance. And by so doing, it can be verified that the creditor balance is no longer in your balance sheet. That makes it realized. But if the amount is being carried in the balance sheet, it means even though the dollar exchange has increased unfavorably, but you have not settled it. So any amount that you have reported as a foreign exchange losses, it is right thing for the FRS or any of the regulator concerned to have them back, because it's not a legit an objective trading expense. So I believe this is very clear. There is also a very topical conversation around the impact of foreign exchange gain or losses on your deferred tax computation. Is Abiodun here? Is Abiodun on this call?
Yes, sir. Good evening, sir.
Yeah, Abiodun, good to have you again. I just want you to assist Folashade in this area and enlighten the public. Many a time we want to compute deferred tax computations, and we have transaction relating to foreign exchange gain, foreign exchange losses being reported there, especially when it is not realized. Will this have any impact when we are making your deferred tax computations?
Yes, it would.
Can you explain to us and why?
Okay, so to start with, let's first affirm the definition of deferred tax asset and liability. So deferred tax is that tax savings that in form of an asset or tax expense that will be incurred in future as a result of the temporary differences that occur into this accounting. So what do we mean by temporary differences? So temporary differences are those differences arising as a result of difference between what a taxman thinks is allowable or taxable now and what the accountant has already made provision for or reported or recognized in the financial statements. So from the angle of streamlining it to the angle of foreign exchange now, let's take it one after the other. We know every foreign exchange transaction we give two effects. It's either we have a gain or a loss. So a gain or a loss relating to deferred tax means that we are looking at the unrealized gain, because in the recent, the realized gain has been subjected to tax in that particular year it was earned. So what that means in essence is that an accountant has reported a realized gain. A taxman also is saying that, okay, this gain is actually a gain that is taxable. They've actually subjected it to tax in that year. So that will not give any deferred tax implication. But in the form of a realized or an unrealized gain, an accountant has already made the necessary recognition by recognizing the income earned on unrealized gain. But a taxman now is saying that this income, though we understand the fact that it has been earned, but it's not yet realized. So we will subject it to tax now. We are going to subject it to tax in the future when this income is realized. So what that means in essence is that, in a layman terms, is that the tax that would have arise from that transaction today, the taxman has pushed it to the forward year when that transaction will now become realized. So an unrealized gain will bring about a deferred tax liability now. So as an accountant, you need to recognize the deferred tax liability that will be suffered in the future when that particular tax become realized. So the other angle is the unrealized loss. So unrealized loss is saying that you as an accountant, you've already made provision for a particular loss that you deem fit you suffered, but it is an unrealized loss. So unrealized in this sense means that no monetary movement has happened as a result of the transaction. No money has been paid or received as a result of the transaction. But because of accounting standard, you need to make provision for that loss. So a taxman will not say this particular loss is not taxable, is not allowable, being that it is an unrealized loss. It is just a mere provision. So a taxman would disallow it in the present tax computation and the disallowing of that particular transaction in the present tax computation will now bring about what we call a deductible temporary difference, which will bring about a tax asset in the future. So what that means is that it's being disallowed in this particular year. Let me say, for instance, year 2024, you have an unrealized loss and a taxman has disallowed it. The disallowing of that unrealized loss will obviously push your profits forward, hereby making you pay more tax, right? But this tax that you've paid will now become a benefit for you in the future when this loss become unrealized. I hope that answers your question, sir.
Yeah, you mean when that particular item become realized in future?
Exactly, so in the future, yes.
All right, so thank you very much for that. I believe our audience has learned from it. As simple as this looks like, you can see that it has a lot of intertwine with various aspects. IAS 12 is income tax, and one of the key areas of income tax is deferred tax computation. So I decide to bring your attention to this as relating to foreign exchange, because when you are making your provisioning for deferred tax purposes and your transaction during the year resulted into a realized exchange gain, that will have no deferred tax impact because that position has been closed currently and there is no dispute between its recognition for tax purposes and accounting purposes. But in an instance where accounting wise, the standard says you should take a position different from what the tax law expects you to recognize is, that will give room for deferred tax, temporary difference that will have impact on deferred tax. Please, I encourage you all to take time to reflect in this. Together we can make accounting profession, audit practice and tax practice proud, and that is the core half of our intention to putting this forward. So I want to give room for more questions, more contributions from participants here before we get a closing remark from the various speakers. Do not forget, if you don't have a good answer on this before now, make reference to our various content ask questions, and try as much as possible to improve yourself on all of these areas. From January till now, we can imagine how many topics that we have considered. We have most of them, the written content on the LinkedIn, which you can go to our page and refresh your understanding of that. Then we have various, most of these also, the Q&A section, the practical section, also uploaded on our YouTube channel or YouTube page. Try as much as possible to revisit that and do yourself good for your competence wise. Any question? Any other questions on all the things we have considered? I do hope you agree with me that every nook and cranny of these topical issues, we cannot totally address it here, but this will be an eye-opener for you to now know the areas of your weakness that have been discussed here and what you can do to bridge that competence gap. Any question from anyone? Any addition? Any contributions? Esther, do you want to make any contribution? Idara, Joy, any questions, contributions, or additions?
No, sir. No, sir.
All right. Elizabeth on Obadina, any question? Any contributions? We would also like to learn from you. That's why we are asking this. So be mobile, any contribution or question. And the representative from Task Club OAU, thank you very much for joining. Any contribution from you or any question you want to ask? All right, somebody from Tax Club OAU. You have the floor.
Good evening, everyone.
Good evening.
First, I'd like to say thank you so much for this session. I've gained so much since 6 p.m. than I've gained in a lot of time, because this is a very value-packed session and it is my first. So I would say thank you. So my question, I'm not really sure if I should say, I didn't want to talk before because this is more poised towards those that are practicing. But my question is more for those that are writing ICANN exam, because we deal with the foreign exchange loss, foreign exchange gain in ICANN question as well. I will get questions like, do we allow, do we disallow? Normally, I know what I've read, we disallow the foreign exchange loss again because we see them as national income and national expenses. But now it's what I've had here that we have realized and unrealized gain and loss. So if we should see such, because I've seen questions that when I check the answer, some were allowed and some were disallowed, and I got really confused as to what exactly I should follow, what exactly I should tell the students while teaching for the ICANN classes. So I would like to put forward the question to you, sir. What exactly should we do when we find foreign exchange loss or gain in ICANN questions, advanced tax to be precise?
All right, thank you very much. That's a very good question to ask. Losses ordinarily is an expense. So whether you have foreign exchange gain or foreign exchange loss, there should be a second question, the second step to analyzing it. Is it realized and is it not realized? If it is a loss is realized if that particular exchange losses has been settled. I would like to explain that with an illustration. We bought goods from, or let's say a particular foreign vendor renders services to us when dollar to a naira was 1,000, right? and the services rendered by that particular vendor is $20,000. Right? So if you multiply that, I think that will give us about how much? Who is punching the calculator? 1,000 times 20,000. Is that 20 million naira? Anybody helping?
Yeah, 20 million naira.
All right. So let's assume that at the year end, in our own case, dollar has also risen again, weakening our naira, and at that date, dollar is now 1,500. How much as at that year end are we owing the vendor? 1,005 times $20,000. What will that give us, please? Who is helping in punching the calculator?
That would be 30 million.
So what we are saying is that ordinarily you were owing the person 20 million. But because of the exchange, that debt of 20 has now increased to 30. So you need to recognize the additional 10 because 20 has already been in your book. You have debited the expense 20 million, you have credited the vendor 20 million. At year end, you have not paid, right? So that particular expense has now increased. So that 10 million, you will debit exchange loss 10 million. You will credit the creditor 10 million, making 30 in total. So that will form a typical example of an unrealized loss. Have you actually paid that money? The answer is no. Because the next period, subsequent event, don't forget that we discussed today, things can happen that could make that dollar exchange rate go further up or go further down. So that is why, because we have not settled it, that's why we call it unrealized. If you're doing tax computation and you see that kind of explanation relating to an item of an exchange loss, right, that is not a legit or an actual expense in the book or in the hand of the company who has engaged the service provider. Therefore, it should be added back, right? And for deferred tax purpose, because that particular difference can reverse, you have to consider it in making your deferred tax provisions. But let's look at it in this way, that as at the year end, truly the amount has increased to 1,500, but you have settled the creditor for the 30 million hold. The accounting entry will still be debit your expense, that is the foreign exchange loss, and credit the creditor. By the time you are now paying the creditor, you will credit your bank and you debit the creditor. So you will still have the foreign exchange loss still in your P&L. But this time, because the credit has been settled, right, it is a realized loss. Realized because you have finally incurred the money. There has been an outflow from your bank account. Nothing would occur that will make that position reverse in the future. Therefore, that particular sort of expense, the foreign exchange loss, will not be added back because it is an allowable expense. The latter is not, is a non-allowable expense because you have not actually incurred it. The former rather, while the latter is actually a business cost that you have actually incurred. So the first one will be added back, the second one will not be added back because it has already legitimately been deducted before. And in relation to deferred tax, that will not form part of your deferred tax provisioning because accounting treatment and tax treatment aligns. There is no disparity or differences in the recognition of presentation criteria. Hence, it will have no impact on deferred tax provisions. So my colleague from Tax Club, OAU, I believe that fully addresses your question.
Yes, sir. Thank you very much, sir.
All right, thank you very much. Any other question from anyone? Please feel free. Even from academics, you can see somebody has also put a question forward. So anytime we are looking at any topic, if it's a concern you have in the course of various personal study or prep for exams relating to that very topic, feel free to address it. The same way to addressing it, the appropriate answer that may be deemed fit in that scenario will be given to you. Any other question before we wrap this session up? Any question? Any contribution? All right, so in the absence of any other question, I'd like Ridwan to give the final words on ISA 560.
Okay, thank you so much, sir. So our prestigious listeners, ISA 560 subsequent events highlight the critical importance of considering events after the reporting period when finalizing financial statements. The auditor's role in this process is vital as it strengthens stakeholders' confidence and enhances the quality of financial disclosure. And as auditor, we must remain vigilant in assessing both adjusting and the non-adjusting event and ensuring timely communication where and when necessary. Thank you for your attention.
All right, sir. And to the auditors, don't also forget that you have to update your work paper accordingly. To ensure that every of your opinion is very verifiable. Right. Thank you, Mr. Ridwan. So my very amiable colleague, Amazing Peace, who has spoken on IAS 10, can we have your final words, please?
Thank you very much. Yes, what I'll say, thank you for listening to today's topic IAS 10, events after reporting date. And what I'll say is that accountants in practice, aspiring accountants, they all need to exercise professional judgment in order to determine the adjusting events, the non-adjusting events, and determine how to update and disclose these events. Understanding this standard ensures us recording accurately, and also it helps us to make informed decisions and develop our skills proficiently. So thank you so much for listening to today's message.
All right, thank you, Amazing Peace. We spoke on IAS 10, right? Events after reporting dates, which could be adjusting. In our words, we confirm that it is adjusting when, among other additional conditions, when the physical balances as at the year end, by reason of the occurrence after the year end, makes those balances to be distorted. Therefore, there is a need for you to reflect correctly what the balance will now be by reason of that subsequent event. And it is instructive to state that IAS 10 will not prescribe how you will make those adjustments, especially where there is a particular standard relating to that element of the account, right, that subsequent event imparted. My point is this: in an instance where your inventory was imparted by a subsequent event, be it fire, flood, or theft or anything, thus distorting the actual earlier closing balances. IAS did not say you must debit this or credit that. Rather, it only helps you in identifying what is adjusting and stressing the need for you to adjust accordingly. But on how to adjust, you will need to make reference to IAS 2, which is the specific standard relating to that. And the provisions of IAS 2 is very clear, inventory. It says that when the adjusted impact will result into a value higher than the actual or original cost, the standard did not support that you should report a value above the original or historical cost. But if the adjusting events resulted or will result in another value less than the original cost, it expects, in line with prudency concept, that particular inventory balance should then be written down to the new costs. So the point I'm making in relation to that is that in properly interpreting the adjusting and non-adjusting events and what to do, how to doing it, you need to ask yourself convincingly, is there any particular standard that addresses that particular item of transaction? If there is a specific standard, that adjustment must be done in line with what that particular standard has emphasized. Then on the other hand, for non-adjusting, you are not changing the numbers, but it is very essential that you let the public know what development have occurred, right? Because as non-disclosing that or over-disclosing that could influence their decision. So there is a need to ensure that every stakeholder or users of that financial statement is duly informed. So thank you very much for your meaningful and insightful contribution, amazing piece, and it's been a very good moment with you. Afamashade, let's get back to you. Afamashade has discussed with us on the tax implication of foreign exchange. Can we have your final words, please?
Yes, sir. Thank you, everyone, for listening. So my final word is that it is not enough for us to view, it's not enough for us to see exchange gain on financial statements and treat it as either disallowable or not disallowable for tax purposes. We should always get clarification and we should always get confirmation from the client or the accountant on why the exchange gain is realized or not. Thank you.
So thank you very much. So with this, we have come to the end of the session today. We do hope you will join us same time next month for another insightful deliberation. But before then, we need any of the general public to give us a vote of thanks. Ayomide, Toby, tell us how this has impacted you and what you will need to hear from us the next time. Esther, can we hear from any of you other than those speakers? Or somebody from the OAU task force? Anyone? Anyone?
Okay, thank you very much.
Oh,
yes, I'm there. Okay, thank you very much. It was really insightful, especially the issue I had with balancing figure of the bank statement and the ERP. Really grateful. As regards the IAS 10 and ISA, thank you very much as regards that.
I said ISA 560.
Yes, the ISA 560 as well. So like it was insightful to know the standards, the nitty gritty about those standards and how it applies. So this were some there were some parts that I wasn't really aware of, especially those adjustment parts and the foreign exchange and all that stuff. The realized and not realized, when to realize and when not to realize. So I'm really grateful as regards the insightful knowledge sharing. Yeah, thank you.
Thank you very much. Is there any other area in accounting, tax, or audit you would like us to speak on? That interests you that we can speak on, maybe we'll consider for next time.
It will have to be this withholding and withholding tax with oil companies, and the whole dynamics as regards the 10%, the 5%, when to do 5%, when to do 10%, and all that stuff.
Okay, please take note of that. Okay, anything on accounting that you want us to talk about?
Okay, as regards accounting, nothing really comes to head right now, to be honest. But yeah, if something comes to head, I'll definitely know about it. Thank you.
All right. From any other person, is there any contributions again before we close up? Any contribution or topic you want us to consider that interests you or that is of a concern? All right, so in the absence of any, I want to appreciate everyone for your time tonight. I do hope in the least minimal way we have opened your eyes to some other areas you might need to further develop on. We wish you all the very best even in the remaining days of this month, and by God's grace, we hope to be together also in the coming month. Enjoy the rest of your night and have an amazing, peaceful September ending. Good night, everyone.
Good night.
Thank you, Sam. Good night.